guest now on the show. Special guest needs no introduction in the world of financial market. Nilesh Shah, MD of Kotak AMC, is now with us. Nilesh bhai, thank you so much for taking out time for our viewers. We've seen a decent pullback in the month of July. When we look at the lows at Nifty 15,100, we are now at 16,600. Similar with US, crude probably has come down. But one would still say that people were short earlier or markets were too much pessimistic and now it's making some rationality. How to approach the market from here on? How should one look at the market? Are markets up 6% from the lows is the way to look at it? Or probably we are just attaining to sanity and now stocks may react to numbers and the news flow that comes in?
So right now, clearly market is processing data. When commodity prices, including crude, went up, the valuations were a little ahead of their fundamentals. Market was optimist and the correction happened. Then one other extreme happened where markets corrected. They fall little below their fundamentals, but not by much. And then suddenly commodity prices corrected. The crude hasn't corrected as much as we would have loved. So clearly markets will be driven by how events shape up. There are four key events which will continue to influence market. The evolving geopolitical scenario with US, Ukraine and Russia coming together. The second will be oil prices and especially European winter and gas prices. The third will be inflation debate. Clearly, it looks like with commodity prices coming down, inflation is on way down. And the final thing will be US recession. And what does Fed do? Do they raise interest rates and then cut suddenly? Or do they tolerate little higher inflation to ward off recession? So these four factors will continue to influence market on a top-down basis. And as a fund manager, you have to pick up stocks on a bottom-up basis, which will be able to overcome this four factors or wall of worries.
Right. Nilesh sir, we have also seen that, markets have punished some of the high value names or high valuation names, which were earlier trading on probably price to sales, where EBIT margins were very low or losses were pretty high, seeing a decent amount of correction. Whenever there will be a risk aversion, such sort of themes would tend to underperform, and this is no different?
Undoubtedly, when you are in doubt, you want to go back to safety. Despite weak US economic fundamentals, the safe trade is to go to dollar, and we have seen dollar index at nearly all-time high level. The same thing applies in equity market. You want safety in profitability, cash flow, and dividend yield when there is risk aversion. And we have seen high valuation stocks, not only across new age companies, but also in consumer staples and FMCG underperforming the market. Now, obviously, risk is a cyclical thing. There are times when you are risk averse. There are times when you want to take risk. So again, as I mentioned, this is the market for bottom-up stock picking. Keep a diversified portfolio. You never know how things will shape up in future. Keep some dry powder for buying on correction. We have weathered the storm quite well, but it doesn't mean that we are out of the storm. Yesterday, it was very nice to see one chart where India was right at the bottom with a score 0. This was the Bloomberg analysis on expectation of recession in an economy, and we were right there at the bottom. So clearly, we are far better off compared to the rest of the world, but we still have to be careful about how events shape up.
Good morning. So that's your advice, which is coming in for our viewers. Have dry powder to buy on dips to correct all of your regrets. Stay diversified as well. But Nilesh Shah, I want to ask you one question. The earnings season so far, it gave a lot of opportunities, right? For example, look at IT. We even saw TCS fall below 3,000 rupee a share. You saw HCL Tech, Wipro, TCS all falling to 52-week lows. We saw what happened with the Reliance, how the street estimates were missed by the conglomerate. We're, of course, now in the second leg. We've also seen numbers from FMCG counters. The earnings so far, what do you make of it?
So we have seen by and large earnings which is in line with expectations or better, bearing few of the counters which you mentioned. Now, if we aggregate the entire earnings, it is little below expectation, but it is driven more by IT sector and oil and gas sector where there are some misses. If we look at cement sector, the PAT drop is lower than what was priced by the market. If we look at banking sector, earnings growth is ahead of market expectation. If you look at bellwether stocks in FMCG sector, despite inflation impacting margin, earnings have come ahead of expectation. So bearing few large counters which have a much higher weightage on earnings, overall results so far which have come is either ahead of expectations or in line with expectation. But do remember that good results generally come in the first half and the bad results tend to bunched up together in the second half. So our feeling is that June 22 quarterly earnings will be little below market expectation. It will be driven by inflation hitting the margin. However, what is more critical is the guidance going forward. And surprisingly, despite all the uncertainty, companies are giving reasonably positive guidance. Even in IT stock, where the margins have been hit, the guidance has been marginally revised upwards. So overall, the earnings will be below market expectation on an aggregate, and the guidance will hopefully support the market at lower level.
So if I read between the lines also, what you are expecting, Nilesh Shah, is banks to outperform. A, have I got that right? And, as our viewers prepare for the next bull run, where should capital goods fit in? Because the two of them do tie in together, the infrastructure story.
So these are the two sectors where we are bullish. In banks' case, NPAs are at decadal low level. NPAs are reasonably well provided for. As interest rates have gone up, margins will expand. And as the policy rate normalizes, the treasury losses can be reversed, or even if it's not reversed, the mark-to-market notional losses will get converted into income. And more importantly, over the last 3 years, most of the banks have underperformed the market. So reasonable valuation, expanding NIM, fully provided NPAs, put together, it's no-brainer that financial services stock, especially private sector banks and certain PSU banks, will be a market outperformer. The second thing where we are bullish on an aggregate is manufacturing. Thanks to China Plus One, we have seen some traction in sectors like electricals, electronic components, mobile phone, handset manufacturing. We believe as capacity utilization has gone back to 75% plus level, many companies have started revising their investment plan. Capital goods company over last 4 or 5 years had virtually very limited business. So they have cut costs, they are fighting fit. And now as order flow happens both from local market as well as global markets, they should be in a position to have operating leverage. Earnings growth in capital goods sector from here onwards looks fairly fabulous. I believe there will be some opportunity as energy prices make European manufacturing uncompetitive. It might be temporary in nature, but it can be one more catalyst to shift manufacturing base out of China, out of Europe into India. Put all these things together, we believe capital goods as well as manufacturing companies should have good runs going forward. Obviously, it will not be a straight run. There will be disappointments as well on the road. but overall banking and capital goods should reward investors.
But Nilesh, considering you track the macros as well as closely with a magnifying glass, where does the currency weakness tie into the entire equation? And is that what is keeping the FII fraternity away, barring what we've seen in the last 10 days?
So in my interaction with FPIs, I have rarely seen anyone bothered about currency because, there will be certain FPIs who may be trading oriented, hedge fund oriented, and for them currency makes a lot of difference. But for most other FPIs, which are majority in India, they are long-term investors. They are not investing with 1 month, 2 month, 3 month view. They are here with 3 or 5 year, 7 year view. Now, if you are taking rupee position, you are pricing in rupee depreciation based on the inflation differential and productivity differential. So yes, the weakening of rupee could have impact on the trading oriented FPI flows, but that's very, very marginal. The long-term FPIs will not be really looking at it with too much of seriousness. Number two, as rupee has weakened in dollar terms, it has also appreciated against yen, euro, and GBP. Now, a lot of FPIs do come from US and dollar countries, but there is a reasonable portion in other European and Japanese currency as well. The third thing, rupee has to remain near its real effective exchange rate. If it is undervalued, it could again deter FPIs. If it is overvalued, again, it can deter FPIs. So as long as we are trading our nearer to real effective exchange rate, I don't think so it's going to have an impact on FPI flows. And we have started now seeing that after massive selling from October 21 till now, there is some amount of eagerness coming to invest in India. Growth, we are the fastest growing major economy in the world in 2021 as well as 22. Earnings growth has been fairly decent. With little bit weakening of rupee, we have become more attractive in dollar terms, though not necessarily in GBP, yen, and euro terms. And despite FPI selling, it's been absorbed by local investors, including mutual funds and insurance companies. So my feeling is that if we get a little bit lucky on MSCI, where Korea gets upgraded to developed markets from emerging market, if HDFC Bank, LIC kind of company gets included in MSCI, then our weightage in MSCI goes up, and that will induce fair amount of FPI buying into the country.
Relieved to hear that, Nilesh. Oh, and always good to have you on the show. Good speaking with you.
Thank you.
Okay, that's the word.